Good afternoon, and thank you very much for the invitation. So perhaps my talk should be called Acronym Attack. So if you don't like acronyms, maybe you won't appreciate it. My idea is to give you an overview of all the different transfers mechanisms that you have at the EU level and at the Eurozone level. So I hope 20 minutes will be enough for that. Of course, I should qualify that you cannot just add these amounts onto each other. These are a whole range of programs with all kinds of different distortions. But I think it's very important to make an overview, to make clear how far we have already gone down the rabbit hole of the Hamiltonian Europe, so to speak. And then, of course, I don't mean to compliment the EU with comparing it to Hamilton. So, first of all, the fiscal transfers mechanisms. The fiscal transfer mechanisms. I mean, the most well-known fiscal transfer mechanism in the EU is the so-called MFF, the Multi-Annual Financial Framework, the 7-year budget of the EU, which amounts to 1.1 trillion euro over 7 years. There's several calculations on who the net payers, the net receivers are. You can look at, of course, the absolute contributions, the contributions per capita, the contributions per capita in terms of GNI, but typically we see that countries like Germany, Sweden, the Netherlands are the big contributors of the whole EU budget, and the likes of Bulgaria tend to be the big recipient. Second mechanism is the EU Recovery Fund. I'm sure you've been following that. This was unfortunately agreed last year. It's called NGEU, Next Generation EU. Some call it Debt Generation EU because it has been dubbed by the FT, which was wildly enthusiastic about it, Europe's Hamiltonian moment. What is so special about it? Not so much the amount. The amount is gigantic. It's 800 billion euro. That's one thing. The special thing about it is that it is the sort of the largest joint issuance of debt so far at the EU level, and this makes me rather pessimistic because I don't think this will be a one-off thing. You may have remembered that last year when we had the negotiations, you had the frugal four countries that were opposing this decision, the Netherlands, Denmark, Sweden, and I think it was Austria, and at some point they were frugal 5. Anyway, they lost. But the Dutch Prime Minister said, yeah, we lost, but at least it's a one-off operation. Why is it not going to be a one-off operation? Because it's 800 billion that the EU is borrowing will, of course, at one point need to be paid back. And then there are several options. The EU wants to create EU taxes. It may get its way to a certain degree, but I suspect that's going to be resisted. It may just ask member states to pay up and to pay the bill. Not very realistic, I think. The most realistic thing is, of course, that they will agree to just take out the new loan to pay back the old loan, because that's sort of the standard procedure, I think, apart from Luxembourg, correct me if I'm wrong, for European governments. So unfortunately, this thing is here to stay. And you may have followed the shenanigans with Poland and Hungary being denied their fair share. But I think at some point the EU Commission will just give them the money, and they'll continue with business as usual. I only have 20 minutes, so I've only come to the third scheme, which is the European Investment Bank, technically not part of the EU, but established under the EU Treaty. 429 billion has already been disbursed by this, you could say, European Sovereign Wealth Fund. and they can disburse another 101 billion to all kinds of projects. Then there has been a temporary scheme, the Juncker plan, called EFSI, European Fund for Strategic Investment, amounted to 401 billion of spending, mostly through guarantees. Then more well known is the ESM, the European Stability Mechanism, you could say an embryonic European Finance Ministry, was set up in the wake of the euro crisis, or basically to try to deal with the euro crisis. Has 700 billion at its disposal, 80 billion of capital paid up by Eurozone countries and 620 billion borrowed. It has a maximum lending capacity of 500 billion, but this can be easily increased if they want to, but they don't really like that because then they have to ask the members of the Bundestag to agree with it. Then we have a relatively small thing, a 25 billion pan-European guarantee fund managed by the European Investment Bank, also to cope with the pandemic, decided last year. Then we have more well-known SURE, which is also a European or an EU joint borrowing undertaking. So the EU basically, with the backing of the member states, goes on the markets to borrow 100 billion euro. That money is then used to pay for temporary unemployment schemes. It was also decided in the COVID crisis. So the COVID crisis really, I think, did a lot of bad. Then we have a small thing that exists for a long time, the EU balance of payment support, which basically allows the EU, through also jointly issuing bonds, to provide support up to 50 billion euro to non-euro area member states. So you have to be a member of the EU to get the money, but you can't be a Eurozone member. Then, of course, not to forget, perhaps not entirely right to include in this list, are the Eurozone and EU bailout transfers organized through the IMF. When Greece got into trouble, I think Ireland at some point as well, they got some of their bailouts through the IMF, so European countries were paying through the Eurozone mechanisms and through the IMF. Similar arrangements exist through the World Bank, much smaller amount. I haven't looked at the details of that. Then we had the predecessors of the ESM, sort of the temporary Eurozone lending schemes, the EFSF and the EFSM. The EFSF is only paid by Eurozone countries to undertake Eurozone bailouts, amounted to 440 billion euro, but some bonds are still outstanding, of course. And then you have the EFSM. This is an interesting one because it was a Eurozone bailout scheme, but non-Euro countries like the United Kingdom also took part in this. And this decision in the UK to take part in this EFSM, which only amounts to 60 billion, but also is financed through joint EU borrowing. This was in the UK decided on a weekend. You may remember when Labour had been voted out of office, and it took 5 days, imagine, to form a UK government. Everybody was getting really nervous in the UK. I'm from Belgium. We have the world record, I think 2 years or something almost. Well, during that period, George Osborne gave tacit consent to the Labour government. I think I forgot his name, the finance minister or the chancellor, to agree that the UK would effectively help bail out Eurozone countries. La petite histoire, as we say. Then maybe a small thing to mention is that outside of the MFF ceilings and off budget, we have a number of smaller EU spending schemes that exist. A few hundred million, emergency aid reserve, European Union Solidarity Fund, the flexibility instrument, capped at 600 million a year, and the European Globalization Adjustment Fund, and then the European Peace Facility. Then on top of that, we also have joint EU lending, joint EU borrowing, sorry, of which the proceeds are used to pay for non-EU countries. It exists. it's called macro-financial assistance, but at the moment there's no limit, but only 4.6 billion, so some pocket changes outstanding at the moment. Then also quite important, legally the European Union is not allowed to go into debt, so they sort of do it anyway and call it differently. And apart from this sort of joint borrowing undertakings, they have something called in French restes à liquider, which are unpaid bills. So if you have 300 billion of unpaid bills as the EU have, the EU says, yeah, this is our unpaid bills, it's not debt. I would call it debt. So that's, you could say, a future transfer, given that these bills still need to be paid. So I already made it to part 2. This was the fiscal, an overview of fiscal transfer mechanisms. Now we will go to the second part, which are the monetary transfer mechanisms. Of course, I limit it to the European Central Bank because I'm talking about transfer mechanisms between European countries. I mean, the first way in which the and now it gets really opaque. The first way in which the ECB undertakes transfers is, of course, its interest rate policies. It's NIRP, negative interest rates since 2014 in the Eurozone. The second big, let's say, manner in which they organize these transfers is through asset purchasing. On the one hand, we have quantitative easing, 2,600 billion euro in PSPP, so that's public's, I don't even know, but that's the regular QE. The second QE program has been decided during the pandemic, is PEPP, Pandemic Emergency Purchasing Program. That's the first part of ECB asset purchasing, whereby they basically print money and then buy these assets. The second part is through credit easing, as it's called, and there we have acronyms with the name SMP, OMT, ABSPP, CBPP3, and CSPP. SMP was the first. I mean, you can imagine how attractive this is for politicians. I mean, like, these are massive amounts of money. I mean, if you don't fall asleep while trying to figure out what's going on, then there's something wrong. So this is incredibly interesting to organize all kinds of transfers that are hard to track for civil society, opposition politicians. So this SMP is the Stabilities and Market Program. Is sort of the first of its kind undertaken by the ECB. The second one, OMT, is outright monetary transactions. Is more like a promise. It has never been activated. It was challenged in court, though. I think ultimately the German Constitutional Court signed it off, but with some grumbling. And the idea is a program whereby the bank, ECB, would make purchases in secondary sovereign bond markets under certain conditions, of course, of bonds issued by Eurozone member states. Then you have sort of how do you say that? A twin, but with three, like a tripling. The Asset-Backed Securities Purchase Program, ABSPP, Covered Bond Purchase Program, CBPP3, initiated in 2009, the first one in 2014. And then the third one is Corporate Sector Purchase Program, CSP, 2016. And to be fair, on the website of the ECB, you can sort of see like how their monthly how they have these monthly purchases of that. It fluctuates a bit, but basically hundreds of billions of euros, or in that sense being printed to buy assets. And then the ECB has all kinds of arguments that, yeah, but we are sterilizing this in I would say relatively shady way. So it's incredibly hard to try to calculate the actual distortions of all that. But I'll come to that. A third big part, very important, is of the ECB or monetary transfer mechanisms is ECB subsidized lending programs to banks, the LTRO. So as you know, a central bank lends money at certain relatively low interest rates to banks. These are programs whereby the ECB gives grants especially low interest rates to banks. You have the LTRO, the long-term refinancing operations. And a few years later, the ECB has started with TLTRO, the targeted LTRO. Anyway, in 2020, the estimate was that this had all amounted to 1 trillion euro. So a lot of money. French President Sarkozy was very unhelpful for Germans when he was basically openly saying, well, the idea is that the banks then shift all that money to sovereigns, whereas of course the ECB was pretending it was not engaging in monetary financing as banana republics do, but Sarkozy was basically saying that was not the case, that the whole point of these things was to engage in monetary financing. A fourth mechanism, I would argue, in which you have monetary transfers is the promises that the ECB is making. In 2012, Mario Draghi said he would do, quote-unquote, whatever it takes. The fact that he says that is already, having some, let's say, influence on the value of the euro. So I would say you could also consider that a route through which the ECB is conducting transfers. Last but not least, we have a thing called a Target 2. Target 2 is a, how to explain, a calculation system. If you go on a holiday with friends, and some friends buy the beer, and other friends go to the butcher to buy some meat, and then in the end you compare, how much money has been spent. Well, a similar thing exists at the Eurozone level, and actually in the United States as well with the Fed. What has happened in the Eurozone is Germany. Only Germany has gone to the supermarket, has bought a lot of beer and foods. And at the moment, in October, it had 1.12 trillion in claims on this joint settlement system. Italy and Spain have 1 trillion in debt to that system. Now, first of all, this Target 2 is not something that comes necessarily on top of what I've mentioned. It is sort of like reflecting some of the things. People say, well, this is actually not a transfer yet, and that's true. It will only become a transfer when the Eurozone breaks up. When the group of friends says, oh, we're no longer friends, and then, of course, the friend that has been advancing everything in the supermarket is stuck with the bill, and that friend is Germany. Then we have, last but not least, a small thing. It's called ELA, Emergency Liquidity Assistance. What is this? This is an exceptional arrangement whereby national central banks can print money if their banks need money, when the ECB is not willing to sufficiently print. And this has been used by a number of Eurozone countries, Belgium, Ireland, France, to a very modest degree, but mostly and most notably by Greece, when in 2015 it was partly shut off by the ECB, but while the ECB still allowed it at some point to print up to 90 billion euro a month to keep its banking system alive. That was before that banking system was bailed out with the third Eurozone bailout through the fiscal mechanisms. Last but not least, how do these monetary transfer schemes actually cause transfers and cost? I would say in three ways. You have market distortions and distortions of market signaling first. Then, secondly, of course, when you have new euros being created that are not properly sterilized, you have a depreciation of existing stock of euros, not so much because of the fact that the new euros go to hard assets or that they remain in the banking system, but because the fact that the old euros they're simply depreciated, even if the new euros are not necessarily immediately visible in CPI statistics. And thirdly, a very important distortion is, of course, that this facilitates governments not to engage in reform. Italy has been funded, Belgium has been funded, has not undertaken any proper reform since they have been entering the Eurozone, and this has led to the zombification of the economy. So very hard to quantify the exact damage to taxpayers and savers. That's why politicians love this monetary route so much. So thank you very much.
Thank you very much, Peter. I think we have no time. I have one short question. Have you summed up all those programs can you give us a figure?
Yes. Oh, no. Well, it would not be, it would rightly be criticized if I would do that. But next week on Brussels Report, I plan to publish it, and then every 6 months or so, I'll provide an update so people can try to see what's going on.
It's like a horror movie.
Yes.
So thank you very much, Peter.
Thank you.